And hello and a very good afternoon. Welcome to the Horowitz and Company After Hours pop-up webinar, the question and answer webinar that we do and have been doing each and every week since March. It is December 7th, 2020, and here we are coming into the home stretch finally after what seems like an extremely long year. I don't know, some people are telling me that they feel like, oh man, it seems so long on one hand, but on the other hand, it's like this year has really passed by very quickly. And for others, I think there's a lot of people thinking that, it's none too soon that we get beyond this this year and move beyond it to get into hopefully what is the end of this crazy pandemic. Thank you for spending your time with me during these historic times and each and every Monday spending time going over your questions, discussion about what's happening with markets, the outlook, some of the topics that are highlighting each and every week. And as you know, we started this in the beginning when there was just an incredible amount of uncertainty, confusion, and it was pretty scary times. I mean, we didn't know what was going on, right? We didn't know what was going to be open, what was going to be closed. We didn't know the direction of the pandemic, how bad it was going to get. And well, here we are. How many months later? We're 9 months later. And I think there's still a lot of questions to be answered because we're still not really understanding the direction, the strength, the path, when it's going to be over, how it's going to impact the area of finance in the future, the markets, people, jobs, the economics. There's a lot more clarity now because we are, I think, understanding that there is a significant resistance to close down everything all at once, like was happening in the beginning. Because remember, in the beginning, we didn't know when things were going to open up again. We didn't know how we were going to find, jobs possibly in the future. That's what people were worried about. And here we are now in December, where, yes, over the weekend, we did see some clampdowns in California and continuing problems in other areas, not to mention, of course, the record deaths, which are horrific, on a daily basis from this whole pandemic. But it does seem like, at least from an economic standpoint, that things are getting better slowly but surely. And we'll go over a couple of those things. Markets, well, it just seems like there is an absolute appetite that, well, how much worse can it get? If we didn't destroy the economy at this point, which is in pretty bad shape, and stocks are able to weather this storm, well, what's it going to take to knock these things down again? Is it going to be that there's not going to be enough stimulus maybe? Is it going to be that we're going to see another year's worth of what it is, but we adapted incredibly well from a business standpoint? And I think that people are recognizing that while there are certain sectors in the economy, the leisure and the restaurants and the travel, the entertainment, anything that really requires people to be up close and personal, concerts, cruising, airlines, that those are going to have an impact that lasts well beyond this recent period and even beyond the point where we start getting some hopeful good news out of the vaccines. But the problem is, what we're going to have is the other areas that have picked up dramatically. For example, we look at things like technology and some of the companies that have adapted so incredibly well for this kind of environment. I think that there's a lot to be said about the resilience and the adaptability of our economy and of people. People have learned that, okay, I can't get to work, so what do I have to do? Well, I have to work from the house. Instead of saying, well, I'll never have another meal out. Well, you may not have a meal out, but you may have a meal prepared by a restaurant, and I'll be happy to have it in my house. Now, there's a lot of misery that's also associated with this, we know, but from an economic standpoint, I think we've done pretty well as a country and as a world. Let's do a couple of things real quick before we go any further. Let's mention that anything that we discussed today is not a recommendation to buy or sell any security. Please do not take it as anything more than information and education. That's what we do here each and every Monday. Past results and past performance are no indication of future results, and anything that we discuss shouldn't really be taken as any tax advice or legal advice. please consult your advisor in those areas or your financial advisor before you make any decisions. One more thing I'll mention for those of you that may be new, I'm Andrew Horowitz. I am the founder, president of Horowitz and Company. And, well, again, while we're here each and every week is to learn, make some sense out of what's going on a weekly basis, on a monthly basis, through all this, and to answer your questions is really the most important part of all this, is all about answering your questions to get you, I think, feeling like you're in control again. Because I think that's what we all lost back in March and April, maybe even May, the whole idea that we've lost control. And when we get that control, well, we can be on our path to becoming a disciplined investor, not relying necessarily only on emotions. They're an important part of the process, but not more than 1 or 2% of the process, but to becoming a disciplined investor to make sure that you are set financially for the future. So that's some of the things we're going to talk about. Now, when you are ready, whenever it is, whatever you'd like to ask, you can put it in the Q&A panel down below. Please do not put it in the chat. I'm going to put something in the chat right now because I want to make sure that everybody knows this is kind of a new thing also. This is kind of updated. But the Disciplined Investor Managed Growth Strategy, which are long-short strategy, where we do some hedging, we have core positioning in it, and trading, of course. It's available for anybody that would like to invest. I think it's a great way to diversify your portfolio from a traditional, we'll call it long-only portfolio, whether it's diversified or not. And there is a link right there. There's a quick questionnaire you take, and then you could watch the 4-minute overview video of exactly what is involved in that structure, in that strategy. So something a little bit different, especially if you're thinking that maybe it's time to consider that valuations are a little bit out of whack with interest rates being as low as they are. And maybe you're thinking that, how long is this run going to last? Should I be looking at alternatives, maybe where there's some downside risk mitigation? Anyway, take a look at that. I think it'll be interesting. So answer your questions, ask your questions in the the Q&A panel, and we'll move on from there. Let me give you a quick update on the markets. So in terms of markets, what have they been doing? Well, if markets were a dance, like one of those fancy line dances, like Cotton Eye Joe or The Hustle. Remember that one? Or The Twist. Everybody kind of got involved in that. Or maybe even like a waltz. I mean, what would it be called? Well, one of those fun dances that they have these days is called the wobble. To the wobble, baby. You ever see that? Well, that's what the markets are doing right now. They're wobbling. I don't mean they're wobbling as in they are wobbling, looking to fall over. But what's happening is that each day it looks like whatever was down, the sectors that were hit or that weren't doing well the day before are wobbling around and then picked up the next day. So, for example, you may have on one day, like today, the banks and some of the cyclicals were, materials down, where the technology and healthcare stocks were just plowing higher. And maybe what's going to happen, and what we've seen before, is the next day comes around and all of a sudden, well, those banks and financials pick up really well. Utilities seem to work out really nicely, and real estate picks up. And then the technology shares and maybe the retail is down. So it's been kind of this dance that we've been seeing, with the overriding direction obviously being up or being higher. So that's kind of what's been happening right now. There's this constant carrot that's been dangling in front of investors, enticing them to think that, tomorrow's going to be better. And that's something that we all try to do. I mean, there's a lot of us that, we think, oh, man, it's going to get worse from here. But generally speaking, the longer we think outward, we think about our lives today and how things are. We think, 5 years from now, things will probably be better. I mean, how many of us really are planning on things being worse for ourselves 5 years down the run? I don't think so. I mean, I think most people have a relatively, even if you're miserable and even if you're just disgusted with everything that's out there, I mean, you usually think that you have an optimistic view of the future. It's going to be better. Well, my health may not be because I'm getting older, but generally speaking, it's going to be better in the future. And I think that's what markets are looking at right now, thinking, you know what, first of all, how much worse can it get? We've said that time and time again. But also, when you look out a number of years, even a year from now, you know what, it can't be much worse. I mean, what could be worse? Being engulfed by flames in a global firestorm? I mean, that would be worse. Tides rising to a point that we're all living in stilt houses and we have to be like Kevin Costner in Waterworld? That would probably be worse. But I mean, what are the chances of that? So I think a lot of us and the markets themselves are pricing in that things will be better in the future and that we're going to have the opportunity to really benefit from that. And with the fact that we are seeing the vaccine that 3 companies or maybe even 4 companies have had a really great efficacy level and safety testing of these, and the emergency use authorizations going through the process and hopefully being out there sometime in late December and maybe out to the masses to a degree in the first quarter. And then we could discuss, obviously, with yourselves of how maybe I'm not going to take it or I am going to take it. I'm not sure about this whole Operation Warp Speed, etc. And then on top of that, you add the stimulus that was already put into the economy and then add the other, what is pending right now, that is playing through the system, another $900 billion that could come in the form of new money for businesses that are suffering to tide them over a bit, maybe new money and additional money for unemployment compensation for those that are out of work, as well as help for the areas of testing and vaccination and distribution, as well as the municipalities that are hurting so badly, transportation, etc. And then to top that off, the knowledge that the Biden campaign has been campaigning on the idea that we'll have an infrastructure bill in the multiple trillions of dollars. All these things potentially have the impact of unleashing a massive amount of pent-up demand. Think about it for a second. You know, it's kind of like we've been involved in a near-death experience where many people are still going through that daily grind of being overly cautious. Some people have gotten and been done with the COVID and maybe have the antibodies, so maybe not as strict, but everybody is going through this, wow, this is a horrible event. And when it's over, man, am I going to party? Man, am I going to party? Maybe some people are doing a lot better in business. Maybe people are going to start doing better in business from a tremendous trough, what they're seeing right now in their business. And they're thinking, you know what? When the time comes, when I'm able to go out again and party and do and travel and maybe cruise, maybe go to restaurants, maybe go to a concert, maybe go to a dance club or a bar. There's a lot of pent-up demand. I mean, think about all the people that started going back out to restaurants when there was 25% capacity initially opened up. It was great. It was a great feeling the first time. I'm telling you from my personal experience, the first time I was able to go back to a little bit of normality. So I think that the only problem we're really facing right now is how long is it going to take to get back to that point? Because the longer it takes to get back to that point, the longer it takes that it's going to take for the vaccine to get out there, the longer it's going to take for stimulus to really get in the hands of the people that need it from a fiscal base. And I don't think the Fed, with their low interest rates, is really that important right now. They're important. It's important, but not for the individual. It's not like you're going to say, if you don't have a job, hey, I'm going to borrow lots of money. First of all, you probably can't get it. Secondly, you're not going to want to put on more debt. But the free money and almost free money available for corporations and those that have money are allowing for expansions tremendously. That's why we're finding that the rich are getting richer and the poor are getting the poorer, and the middle class is, well, continuing to disappear. That demarcation between those that have and the have-nots is widening, and that is something that we're going to have to deal with in the future. But the longer it takes us to get this vaccine and to get the immunity around and to get the cure and to go back to normal, the longer it's going to have, I think, or the greater potential for long-lasting damage to the economy. But again, we're very resilient. I mean, you never count out the U.S. consumer. They always say that. They've said it since I've been in business for the last 30 years. And at first I'm like, really? Well, what do people get really upset and they don't want to spend? But that's not how we live. We live on credit. We live on buying things, and we have a culture that is based on things. Whether it's making our house nicer, whether it's getting a nice car, a ring, a coat, whether it's a gift for someone else. I mean, we pride ourselves on things. Materialistic, maybe, but that's what it is. So I think that when I look at the fact that there is the idea of this resiliency in the markets or in the economy and with people, I'm really, it's a good thing, I think. And it's really something to be thinking that the long term will be positive and this pent up demand is real. Now, I want to look at a couple of different things here and talk about and bridge over the idea of this resiliency. So let's talk about two major economic data points. So the first one we're looking at here is the unemployment rate. Okay. Somebody is asking, is there audio? I think there's audio, right? Everybody can hear? I'm seeing this. Restart your meeting. You'll probably be able to hear again, or maybe turn your volume up, or maybe turn your speakers on. Quick check on the chat, please. Can somebody chat back to me if they can hear me? No. Yep, that's what I thought. Yep, we're all loud and clear, so thank you. We're good. So what I want to talk about here is the employment situation. Let me chat this out. Restart your session if audio, sorry. Let me just do something here. Gotta type that in. All right, send that out. So what we're looking at right now is the unemployment rate, and there's two components of it. One is the unemployment rate, the official unemployment rate that we hear about all the time, and that's currently at 6.7%. You can see that spike, right? You can see that big spike that we have that was significant in the beginning of this whole thing, right? On both these two right there, those two major spikes that we're seeing. I'll kind of put them in red for you to see. One is the unemployment rate on the official basis, and one is the unemployment rate, U6, the underemployment rate. That's still pretty elevated, 11.6%. But what's interesting to note is even though we've had 700,000 plus claims on a weekly basis and discussion about seasonal hirings like census workers and pollsters, et cetera, coming off the payrolls, we're still dropping. We went from close to a 15% unemployment rate and immediately started coming down. Now, some of this is a statistical anomaly because when you look at the combination of how it is calculated, how the unemployment rate is calculated, you take in consideration the amount of people that are actually in the workforce, and you take that and you start working on dividing, well, how many people are actually working and looking for work, not working, out of the workforce, et cetera. And what happens is that this labor participation rate, when it starts changing and dropping dramatically, what happens is that oftentimes you'll find that even if no people are added to the payroll, your unemployment rate will actually go down. So what's happening here is that we're seeing that the labor participation rate, more people are off the payrolls, they're out of work, they're discouraged, they're out, they're done. And what happens is we're seeing this anomaly of a 6.7% unemployment rate. Fact is, if you look at alternative areas of when you didn't have the labor participation rate as one of the factors looking at how many people are employed or unemployed in the unemployment rate, you can see that really, but by not tweaking that, by using this statistical process, it's really close to about 8 or 8.5%, maybe even 9%. The other one is the underemployment rate. Again, that's a broader version of unemployed, probably more accurate to the totality of the picture of the employment situations at 11.6% right now. So that's kind of important to understand. Where are we in terms of the rest of our economics? So let's take a look at our ISM. I don't know why these charts got a little weird. It looks like candy canes here. But just follow the line here. It's supposed to be a gradient. I'm not exactly sure what happened. But nonetheless, when you look at this and you look at the ISM, this is a blended composite. If you look at the bottom right here, what we're looking at is a combination of a rate that takes in consideration manufacturing and the services index. Now, the services are approximately a 70% overall amount of the production, or we'll say the United States. So our economy is a service-based economy. About 70% of all the GDP comes from our economy is service-based. About only 30% manufacturing. So what I did was say, okay, well that's good. Let's take then a composite where we combine the ISM service index, 70%, and the ISM manufacturing index, or we'll add the 30%, and let's make a composite out of it to see what the totality of the trend is. And what we could see very clearly was that obviously we landed into a massive amount of contraction. Under 50 is considered contraction back in the heart of the pandemic, right? Really never got in, going back to 2013, this never kind of got close in 2016. It really started climbing, really nicely higher through 2019. Started dropping here. This was interesting on its own without a pandemic. Started dropping, did a quick uptick back towards the beginning of the year, then just fell off. So this move that we're seeing right now, the level that we're seeing where we've had that downstroke and now this upstroke here, these pretty much cancel each other out. And I would venture to say that also because of the deep contraction that we had, we overshot a little bit to the upside here and probably going to start rounding down a little bit back to probably normality, which is probably going to be in the, give or take this 52 range or so for a while, which is kind of that average number that you would expect to see under normal times. Now, there is some talk about this starting to really come down and possibly pin down into the first quarter of next year. So keep your eyes on what's going on there. They're talking about now a negative GDP, and that would also make somewhat sense from a calculated statistical reference point due to the fact that we saw this, this down and up is kind of this retracement that was too hot. So it's going to kind of offer itself down to clean out that excess. And again, it's just a simple, this is a choppy number. We've seen this before throughout the time. You get this chop, and then it kind of comes down after every time we kind of, get this chop. So I think that we're going to see that there is some weakness coming into the next couple quarters potentially. Now, one of the things we also talk about a lot of times is this whole key reversal indicator. Now, it's only a 4 today. It was actually a 5 earlier in the morning today. We're starting to see some clusters. What it's telling us is that markets are starting to get frothy again. And obviously, there's no, I don't think there's anybody saying, really? I mean, markets have been frothy for a while, but we're starting to get into like almost a double froth. It's kind of a double froth cappuccino going on here where you have to be a little bit careful in some of this. I don't think necessarily the downtrend or the uptrend is going to turn into a massive downtrend overnight. I just think we have to get some of the froth and the exuberance relieved for the markets. Starting to see that in certain areas, but we'll have to see it in a lot others that there is a significant amount. The concern about really a big crash here, unless we do see a very watered down stimulus bill or maybe vaccines that don't really work as well as they think they are. I guess that could be an issue. Now, historically, we see there's a chart, and I'll just kind of notate a couple of different areas. We've had these big ups and these cluster formations and these reversals. Starting to see a couple, 4 or 5 of them right here. Again, kind of tipping off into the 5 right there, and then we have mostly 4s. When you get into like the +7s, that's when I start getting nervous. +6s, we're not really there yet, but we haven't seen either that reversal. We've seen it just kind of slowly but surely, a few little baby reversals, kind of, right here. On the next day after that, not seen it yet. We're still on a bit of an uptrend overall. There's no question about that. Bit of a drop today, but not enough to say, oh my gosh, where are we? But point is that markets are overheating significantly. So we'll just leave it at that. All right, so let's see. What else do I have? Oh, and why is this? I think I put this on my paper. Why is this? Because, what else is there? I mean, you can invest a load of your money in bonds that you may think that interest rates are coming up significantly. Are you going to think that there is, alternatives that will do a lot better? And there may be. But right now, with interest rates as low as they are, with the Fed pushing down the pedal as fast as they can, stocks, the valuations are still good. Now, if interest rates start kicking up, we talked about this on the Disciplined Investor podcast this week. If interest rates start kicking up, well, you could have a problem. The question is, how much do they have to kick up to have a problem? So maybe you have to kick up towards the 3% range, I would say, on the 10-year. That's my kind of bogey right now. We're nowhere near that. We're approaching 1%. We're nowhere near 3%. So right now, not much to really be too concerned about, except for the fact that valuations are clocking in pretty high. All right, so give you some time here to ask your questions. We have a couple queued up right now. Again, ask anything that you want, anything that's on your mind, and we will do our best. I will do my best to answer it. And now's your time, because I mentioned that we are going to be ending this at the end of this year. This particular webinar process and series that we do, one of the things we have is that we obviously have the Disciplined Investor Managed Growth Strategy discussion for our clients. We have, and somebody mentioned that on the Q&A right now, which I'll get to. We also have the Disciplined Investor podcast, where we do take listener questions. But let me just mention this because Ben asked this question. He says, with the sessions ending as we move into next year, you had mentioned that this is the type of information that your clients can receive. I am a client and read the updates, which are good, but not near as in-depth, and no way to ask any questions back. What is the best way to get more in-depth information in the future as a client? As for those who are considering becoming clients, having access to the KRI is super helpful for doing swing trades and pulling some money off the table, getting back in when things get high or additional indicators. Yeah, I think what Ben is mentioning is that we post it's the end of day, but we post the KRI indicator on our monthly updates. Well, they're daily updates, but it's a monthly compendium of the updates each month, and in there is embedded the KRI indicator. So we'll probably do something else, maybe not as often, Ben. Remember when we started this, we did it 2 times a week, Mondays and Wednesdays. There's still a lot of interest. This room is full right now. So there's a lot of interest in doing this. I'll figure out what it is. But when I did it originally, I wasn't necessarily intending to do it forever. And when I scheduled it to do it right at this time, I didn't time-wise, it doesn't fit into the bigger picture schedule as I'm doing it. So I'll figure out something. We'll do something. We'll announce it, and then we'll have it. But we'll get something done for you. L asked the question, hey, Andrew, do you have any thoughts on tanker stocks going forward? They seem very cheap here. Happy Hanukkah from Larry. Happy Hanukkah. Thank you. It starts in 3 days, I think. So tanker stocks. Tanker stocks are interesting because there was an overbuild that was happening for some time, and there's different types of tankers. You have the wet tankers, you have the dry tankers, you have the oil tankers, you have these mega tankers, you have the LNG, which is kind of interesting, the liquefied natural gas, which I find is an interesting play. If that's going to be able to be schlepped around the world on those tankers, they're very susceptible to all these energy related, very susceptible to the price of oil, of course. The more oil costs, the more they can pay the tankers. But right now, I think there's an overabundance of the builds that were going on last year. And then the problem is the price of oil is not sustained at a level that allows for an increase in tanker rates. Therefore, a lot of tankers are circling out there with no fuel because demand isn't there. And I think that rates will stay down until there is such a demand. One of the things we are seeing is that prices did move up in anticipation of OPEC increasing prices. They did so to China over, I think, the weekend. But at the same time, when you look at the tankers, due to the fact that there is no other thing really happening on the demand curve other than the fact that there's a hope for demand and a little bit of an increase until the planes are back online, until we have massive transportation that's going on, I just don't see the demand happening in a big way that's going to require a much higher rate on the boats, and therefore that's a problem. However, these things move around pretty significantly. When they start to move out of absolutely nowhere, they can really see a big price tick upward. So I'd watch the price of oil, watch the demand, watch how many barrels are being pulled from the ground. What is the inventory levels on Tuesday nights and on Wednesday mornings, in particular 10:30? You get the API numbers. So something to watch there. If you want to take a piece of these, realizing that it's a total flyer, because you'll never be able to time these right, or watch them very closely for a lift off the bottom. And when they start ticking beyond resistance on a technical basis, it's the time to take a look at it. Ben asked another question. He says, what could be anticipated with this overheating and the quadruple witching coming up, plus S&P rebalance with Tesla? Could that be the straw that breaks the overheating? I think the Tesla is a big issue, actually, because I think that there's a lot of concern that we're having this this conundrum right now that the higher Tesla goes, I think it was up $60 today or so. The higher Tesla goes, the higher amount it comprises, or the greater amount it comprises from a market cap weight in the S&P 500. The higher the market cap weight in the S&P 500, the more shares that need to be bought by the people that are running index funds and possibly even passive / active funds that hold a position and they want it as a certain position in their portfolio. The higher the shares go, the more they have to buy. The more they have to buy, the higher the shares go. And the story goes on and on and on until it's put in. I think that, yes, beyond the date that we have this, and when we get beyond the fact that Tesla is a component in the S&P 500 that has to be bought in, and once we can get those, many billions of dollars in there, I think that's a big issue because you're also going to see, and it's happening already, that some stocks that need to be brought down are in fact being sold off. But it's not as technically, or it's not as apparent as the amount of move that we've seen with Tesla on this. I don't know if that's going to be the straw. I mean, I think that we have to get into the end of the year. One of the things that I really thought would be a bigger issue in December is the potential for some tax selling into the unknown. Not knowing what we were going to see in terms of the amount of taxes that will be in the future if, in fact, there was a quote-unquote blue wave where we'd probably see an increase in corporate taxes and possibly also in individual tax rates. Not having that, at least at this point, we still have Georgia to deal with, but not having that blue wave and not anticipate of having that blue wave, we're not going to have that. In addition to that, one of the tax selling issues that you usually see towards the end of the year is probably not going to happen at the level it happened in the past years. And that's because that the required minimum distributions on IRAs are not necessarily required this year. Now, we've counseled our clients to actually do it. We said, you know what, unless you tell us otherwise, we want to take that distribution this year. And the main reason for that is we don't know what's going to be the actual tax rates in the future. And if we don't know that, why not take some of it off the table? Because if they do go up in the future, what's going to happen is that, well, not taking that distribution now and it moving higher in value in the future would require you to take more money and pay higher taxes. And that would mean that if taxes are higher, that would be a higher cost to you. So therefore, we know what we have right now. Let's take the distribution. Let's not make any changes, just because it's available, and let's move on. So that, though, for many people is an issue that they don't have to deal with anymore. And if you don't have to take the requirement distributions, you may not be selling right now to free up enough cash to take that distribution. So something to think about. We'll see what happens as we go closer to the end of the year. The main issue, obviously, is the valuation issue with regard to interest rates. And again, as we have interest rates under 1% on the 10-year and still very low, valuations are just, they're not appealing, but people are like, well, until something happens bad, I'm not taking it out. Chris asks, he says, do you see any plays related to COVID-19 vaccine distribution here? For example, would you look into dry ice manufacturers or particular shipping partners or anything like that? Thanks. So I don't usually give out individual stock tips here, if you will, but I will tell you, because I've mentioned it before, right up this alley, and just to kind of really answer this question, UPS has partnered, and I think FedEx too, if you think about it, but UPS definitely has announced a partnership with a company, and what they're doing is providing distribution, called boxes or ways to distribute extremely cold deliveries and storage. And that's going to be necessary for this vaccine, right? We have anywhere from a negative 70 to a negative 20 degrees that they have to be stored at. And that being the case, we're going to need a lot of distribution, storage, and logistical process. And who's going to really be delivering this stuff? It's not going to be like a new company out of nowhere. So I think UPS is an interesting play right now on this distribution process, and especially because they partnered with a company. You can look it up. Just look up UPS partner vaccine. I'll probably give you the answer right there. Another question comes in. I always hear people saying that rolling options in the next month. How? Please provide detail if I lose. Okay. I saw this question come in an email today, so we'll answer it here instead. So the question is, I always hear people and said rolling options into the next month. How do I do that? Please provide details. I often lose 100% on my call options. Can you really sell anything nowadays because it keeps ripping higher and higher? Where do all these monies come from? Stimulus, sector rotation, money sitting on the sidelines? What is your exit plan or profit-taking strategy? Besides 1 foot in and 1 foot out, do you set 10 to 20% stop limits? All right, there's a lot here. Let's unpack this a little bit. First of all, when it talks about rolling your options, you do it before they're worthless, obviously. So what you want to do is, if you're not making money on something and it's halfway into the period that maybe you're thinking about, what you'll do is you'll say, okay, instead of buying the call option or selling the call option or buying a put, whatever it is, let's say it's due in January, and I'm starting to think that maybe these numbers aren't right. What I could do is do a roll up, roll down, roll out. Roll up, roll down, roll out. What that means, I'm going to roll up. I'm going to say, well, if I have a strike price on ABC stock that I was looking at 50, I'm going to take it up to 55 and roll it out another month. Give me some more time, some more space, or roll it down. And what you do is you can actually take whatever you have available. If you didn't lose any money, or if you have some loss, take that and move it into the next month. And then so you can either do with the money that's available or add money to it. So when people say they roll it into the next month, they usually are saying they didn't make their nut, they didn't make their number, they didn't get any profit on this. I'm going to try to do it out in the future a little bit longer because, as we know, options have a certain maturity. They have a certain time decay. And what happens is that over time, if you don't meet your number, you're going to be susceptible to losses. So you could roll out, roll up, roll down, roll out. And basically what you're going to do is change your strike price, move it out in time. Now, the other question you ask is, can anybody really sell anything nowadays because it keeps ripping higher and higher, where all these monies come from? Well, monies are there's a mechanic. I had a whole podcast on this. The idea, and a paper I wrote on this as well, about the mechanics involved in markets. Remember something, that more people buy, the general concept that people are buying rather than selling. How are they doing that? Well, they constantly have 401k money coming in that's going into their investments. They have IRA money that comes up that they put into, and they segregate that to put into their accounts. But the 401ks, week in and week out, there's money. The more higher employment you have, the higher level of money that goes in on a regular basis into retirement plans. So that's number one. Number two, yes, stimulus. Yes, there was direct money, and a lot of money that went into these Robinhood accounts and into trading accounts were in multiples of 300 and 600. And what does that tell you? People were taking their unemployment and they were shoving it right into the stock market, saying, you know what? I think eventually maybe there'll be more. So what the hell? I'll gamble it and see what happens. But stimulus is a big issue. You also have institutions and hedge funds that are making moves in and out, and that's your sector rotation. And yes, there is a lot of money that is sitting on the sidelines. There's always money on the sidelines. And the question is, how much do people want to get involved? Right now, it does seem like an absurd amount of money that keeps on coming into the market under all circumstances. In terms of profit taking, that all depends on what we're looking at and the time frame that we're looking at. On some of our positions, we do have stops that we have in terms of more so than just an arbitrary percentage. We look at where the resistance and support is, and if we're going to take profits or losses at certain levels on that. So if we see a level that is being breached on the downside, it doesn't matter if it's 12% or 13% lower, that's an area that we're going to take our loss and say, we're done with it. We may get into something and say, you know what? We will hold the line here because we're on support. If it dips 5% under, that's where we're going to look to take the position out, because we think that's another potential move down. So it all depends. It's based on technical analysis. It's based on the patterns that develop within that particular name. How much off of their levels of support resistance are they, and what do we want to do about it if it breaks that? So I think that's kind of hopefully gives you your answer to that question. We're going to end it here today. I have a couple of meetings coming up this evening, so I want to thank you all for joining me. Be there for the DH Unplugged live stream tomorrow night at 9 p.m. Eastern Time, and with John C. Dvorak, myself, as well as make sure to listen to this week's TDI, the Disciplined Investor Podcast. Thanks for joining me, everybody, and I will see you again next week.